Every single day, the financial industry spends billions of dollars to convince you of a dangerous lie, that building enduring wealth must be complicated. They market intricate hedge funds, multi-screen trading setups, exotic derivatives, and elaborate tactical rebalancing systems. But if you strip away the polished marketing, Wall Street's most uncomfortable secret is remarkably simple. The more active decisions you make with your money, the poorer you are statistically likely to become. Over a 30-year horizon, nearly 95% of professional fund managers fail to outperform a plain, unmanaged basket of the broad economy. Yet millions of intelligent people continue to exhaust their mental energy chasing sector bets, commodities, and speculative trends in a desperate search for control. True financial sovereignty is not built on complexity. It is engineered through quiet, disciplined execution. And today, this is Moni Explained. Human biology was never designed for modern financial markets. Our brains evolved in an environment where immediate physical action determined survival. When danger appeared, doing something, running, fighting, or scanning the horizon kept you alive. But in capital markets, that exact evolutionary wiring transforms into an expensive cognitive trap known as action bias. When market volatility strikes, instinct screams at you to tinker, rebalance, and trade. The financial industry profits directly from this anxiety, collecting management fees, transaction spreads, and tax penalties on every move you make. Decades of empirical data confirm that the most resilient investment architecture ever conceived relies on only three foundational ingredients: total domestic equities, total international equities, and high-quality fixed income bonds. If you are fascinated by how money, psychology, and global power really operate beneath the surface, subscribe to Moni Explained, leave a like, and share this with someone who values the truth over appearances. Now, let us look closer. Here's what almost everyone gets wrong about building an unbreakable portfolio. Most beginners obsess over chasing the single highest mathematical return on paper. They optimize spreadsheets for peak performance, assuming they will behave like unfeeling machines during an economic panic. But the mathematically optimal portfolio is entirely worthless if you cannot psychologically survive the drawdowns required to hold it. Consider the first pillar of the three-fund model, the total domestic stock market index. By owning an entire economy rather than picking individual corporate winners, you capture the aggregate productivity of human innovation without risking the catastrophic bankruptcy of any single enterprise. Equities, however, are inherently volatile. During severe economic crises, an all-stock portfolio can easily lose half its value. That is where the real damage occurs. When a portfolio is cut in half, the average investor does not calmly calculate 30-year historical averages. Their amygdala triggers panic, compelling them to liquidate assets at the worst possible moment. This is where the second pillar, high-quality bonds, reveals its true purpose. Many modern retail investors dismiss bonds entirely, claiming that fixed income sacrifices too much compounding growth. But the numbers tell a completely different story. Analysis of stock and bond performance dating all the way back to 1926 reveals a startling reality. Shifting from a 100% stock allocation down to an 80-20 stock to bond split reduced the average annual return by only about 0.7%. Yet in the worst historical market crashes, that 20% bond cushion softened a devastating negative 43% drop down to negative 35%. Think about what that actually costs you versus what it provides. You surrender a tiny fraction of theoretical upside in exchange for an 8% psychological margin of safety. That is the exact difference between panic selling at the bottom and staying invested for decades. Then comes the third component, international equities. A common belief among domestic investors is that mega-cap American corporations already generate substantial revenue overseas, making a dedicated international fund unnecessary. On the surface, it looks like success. Beneath it, this perspective confuses corporate sales with geographic diversification. Earning revenue globally is not the same as owning direct equity in European industrial leaders, Asian technology conglomerates, and emerging market powerhouses. Market leadership rotates across generations. Holding a dedicated international index protects your capital from being held hostage by the policy mistakes, currency fluctuations, or economic stagnation of any single nation. Yet despite the elegance of this three-part foundation, retail investors constantly succumb to complexity bias. We are conditioned to believe that sophisticated problems require intricate solutions. As a result, investors clutter their accounts with real estate investment trusts, commodities, gold, and thematic sector funds. Think about what that actually costs you. Every added layer creates friction, higher expense ratios, and tax drag. When a portfolio contains 10 moving parts, several will inevitably underperform at any given time, constantly tempting you to second-guess your strategy. The greatest misconception that Wall Street preserves is that successful investing is a test of intelligence. In reality, it is a test of temperament. Modern research into sequence of returns risk reveals that the greatest threat to your retirement is not average 30-year performance, but the timing of market downturns right before and after you exit the workforce. If a major crash occurs in the first years of retirement, an unprotected portfolio can permanently deplete your principal. By establishing a balanced three-fund baseline and adjusting the equity-to-bond ratio as your ability, willingness, and need to take risk changes, you insulate your future self from financial catastrophe. Real wealth is quiet. It does not require analyzing candlestick charts, paying percentage-based advisory fees, or reacting to breaking financial news. It requires harnessing the compounding power of the global economy, automating your investments, and reclaiming your time. Wall Street sells illusion control because hyperactive trading generates revenue for the institution, while patient inaction builds wealth for the individual. The three-fund portfolio does not promise overnight riches, nor does it stroke the ego of those seeking the thrill of the trade. What it provides is far more enduring, a mathematically grounded framework designed to preserve your peace of mind and protect your autonomy for a lifetime. Thanks for watching Moni Explained. Do not forget to subscribe, and I will see you in the next video.